Greetings everyone again. It's been about a month since I've done one of these recordings and just wanted to what we're thinking now. We know the market is acting a bit nerving something for people. Actually have come a long way. We've hit record highs. Even in the global industries now, Morgan Stanley World MSCI World Index. So we've come a long way, and we think this will be refreshing. Just get to the bottom line, and we'll get into why we think that after we go through normal drill here. Start with fiscal policy, then monetary policy, then go to economic indicators, some market indicators, and we'll talk about the corrections and we see from here. As you know, we're very long-term in our focus. Everything we do is 5-year investment time horizon associated with it, whether it's a research or portfolio. Talk about or from that angle, what's going on today. So on fiscal policy, I guess Congress couldn't get it together for another relief package. So we do have the executive order placed, which does defer payroll taxes into next year. Now, if the president is taking reluctant, we believe he's saying the forgiveness of that deferral and is rally Congress to try and get it. And if not, then workers will have to pay double taxes next year, double payroll taxes, in order to make up for the defer. So it is perhaps bringing some activity into this year that might a little faster than the case. It wouldn't be as powerful as forgiveness of payroll taxes for employees and employers for the rest of this year. Nonetheless, it is something. On monetary policy, what we got some more information from Fed Chairman Powell last week or so, and the information was essentially, we're very focused both and employment and inflation, a little more emphasis than perhaps historically on employment given where we are right now, still very high employment rate, getting to minute 2 report. But there was a very interesting nuance introduced on the inflation side of the heading in the direction. Essentially, the policy response is going to be asymmetric. If inflation rises 2%, and based on the core piece later, inflation metric that Fed seems to like the death. It now is 1.3%, but if it were to go above 2%, the Fed essentially would allow to continue to move above 2% in order to make up for lost time. We've been under 2% for so long, and we're not even sure that measure is correct. If ARC is right, that is overstated. Inflation, even the 1.3% given the forces at work and economy. But at least the Fed is saying if the measure itself occurs to 2%, the Fed is not going to react right away. And on the other hand, if it drops below 2%, let's say go above 2%, drops below 2%, it'll act right away. That's what we mean by asymmetric response. So again, the Fed is reassuring the market that it has their back. You wouldn't know from this week, but the Fed certainly is willing to err on the side of easing too much. So that's information, and that's important. On the economics indicators, today is an important day. The first Friday of every month usually is. We got the unemployment report. Unemployment dropped back into the single digit. I think most people are very surprised that happened before the election at all. we peaked the 14% it turns out, and we're down to 8.4%. Of course, we're below 3% in January, February, so still high by relation to where we were before, but essentially we're nearly cut in half, which is a lot of work done in a few months. Some of the other interesting statistics out of the report just underline how strong the economy is and how much of the V-shaped recovery we're in. Household employment was up 3.7 million. Now, household employment is a different metric, not far from employment. What the survey measures is what businesses have. Household employment, households done that. So it captures more small businesses. So what I think is saying is even small businesses are getting back no small business information. New formation have surged. What we are seeing is sure a lot of bankruptcies and probably a lot more to come, but what these entrepreneurs do is turn around and start all over, especially now that they're being treated more like larger corporations and can declare bankruptcy and get out of a firm under that debt. And I still think that underestimated in here in terms of the positive impact that is having on the economy. The work week also went up, going up 0.1 hour. Doesn't sound like a lot, but that's the equivalent of, I think it's disproportionate in terms of impact on economic activity relative to the increase in employment. And what we saw in the manufacturing sector was 3/10 of the increase, 3/10 per hour increase in the work week, plus a 1/10 increase in overtime. What this is telling us and reinforcing is that businesses are scrambling to keep up with demand. They have been way maybe on the curve before the coronavirus, make up for a lost time, even if the coronavirus has hit. Even more conservatively postured during the coronavirus, and now the consumers is really coming out flying. They're having to scramble to catch up. I don't know if any of you are experiencing, but when I go to a supermarket, I'm seeing not in the toilet paper shelves, but in many other shelves, they're not as full as they normally are. In my supermarket, at a village market, they could keep it fully stocked. They can't. So I do think there is a scramble here, even for food and so forth. And then I don't have to tell you too much about housing because it's been heading the headline recently on both housing starts and existing home sale. We are seeing increases on year-over-year basis now. Last year was fairly strong. We were well pre-pandemic. Year-over-year, against those comparisons, existing home sales and housing starts are both up in the mid-20s percent range, and we've seen number of prices triple. So the raw material costs are going up. We've seen the mortgage rate bottoming out here. And these are two reasons for people who have been thinking about buying a second home or moving from suburbs buying home, for them to act now rather than waiting, because raw material costs are going up. Extensionally, think about that, tripling in the number cost. And interest rates seem to be bottoming out. In bonds are in the bottom here for a while, but they may not. So jump off the fence now. I guess the message is associated with that. Auto sales also have come back a lot more strongly than we anticipated. And these are new auto sales. The reason we are surprised is we saw with the bankruptcy of Hertz, a flood of used cars in the market. I think Hertz alone is responsible for 700,000 of them. And what I've learned over this pandemic is statistics I didn't know. And I know a lot of economic statistics, having watched them for more than 40 years. The used car market, 40 million units per year. And what we are seeing was significant weakness in used car prices. They came right back. Why is that? They came right back even though there were flood of cars into the market, because most people decided during the pandemic that they would not be taking mass transit for some time. And so they decided to buy that second car. So that has fostered the used car market. And it has also fostered the new car sales statistics. So new car sales have gone for 8.6 million units at annual rate to 15.2. And before this, the study is little north of 70 million. So we're pretty close to where we were before. Now, in our brainstorm today, we talked about auto sales. If we look at the statistics now, it is clear that total new auto sales peaked in 2017 at 95 million units around the world. And they have started what we believe a secular decline. But we think that could be cut in half. Maybe not quite half, maybe by 2/3 in the next 10 years. As we move toward a ride-hailing generally, as you know, we think Tesla is going to be launching its own hailing network soon. And as we move to autonomous, and reason that is because for the same reason ride-hailing itself is important. Those cars will be operating 50, 60, 70% of the day without a human driver, and so we need fewer cars because we each are putting cut down on a number of cars we have, because autonomous with cheaper actually, so market share will go toward them. These are 5% per day. And autonomous, even ride-hailing, is at least 10 times that. So we'll need fewer cars on the road. And we'll need fewer parking spaces in the United States. For every car on the road today, there are 5 parking spaces. If autonomous were to become ubiquitous, as you think it will long term, the need for parking spaces drop dramatically. Will probably be more like 1 for 1 instead of 5 for 1. So that's interesting nuance out there. Also on the economic front, we got ISM index. That's for the manufacturing sector in the United States. And we saw it continuing to move up, well above 15% was the demarcation point between contraction and expansion. But we also get inside of that important new orders in the ISM index surged to 67.6. We have not seen that high of a number since December of 2003. So even after 2009 rebound, it did not get back there. That's because the rebound itself after so holding and full of fear. We also know that inventory liquidated or second quarter, this is US number, but I wouldn't be surprised if it's true globally. And we've got July readings, so show for all businesses, meaning manufacturing, wholesale, and retail. Another significant liquidation, 0.2% month to month, which would be equivalent of 12% plus an annualized rate. That's quite significant, but if you again peel a little further, what you see is the big liquidation, manufacturing and wholesale. There actually was 1.2% increase in retail inventories. That's a big increase. This is because retailers are beginning to replenish their shelves, and they're probably having found some success at it, and so they will be pulling at the supply chain as hard as they have recently. So maybe wholesale and manufacturing will catch up pretty quickly as well. Then in this other statistics that we have found to be very important as a guide throughout this deal is the saving rate. Now, the saving rate peaked in April at 34%. That's record-breaking. We've never seen anything like that before. Before the coronavirus, the saving rate was high by the historical standards at 8%. I remember in the 90s, I think, or maybe it was sometime in the 2000s, we were down to nearly zero in the saving rate. It's really associated with a high level of consumer confidence. So the consumers, they want to get buffer under them, which is good. There are not a lot of speculations. Now, after this would be a July number, the saving rate is down to 17%. 17% is still double where we were in pre-COVID. And what that tells us is two things. One, consumers having been through this ordeal might want to just a little bit higher of a buffer. We doubt 17% is that number, maybe 10%. So what that also suggests is there pent-up demand still. We see the pent-up demand more in services or course for good. They get good more easily than access services. So as services do open up a little by little, I think that's going to be a nice booster to consumer spending. As services is the largest part of consumers than spending. You've got durables, non-durables, and services. Services, the largest part. So important. And another metric that came out this week, consumers net worth in the United States. Consumer net worth is about $124 trillion. Think about that. $124 trillion. Our GDP is about $21 trillion. So GDP is a measure of the goods and services produced in the United States. And so that's 21 trillion. And consumer net worth, which is consumer assets, so think stocks, bonds, houses, and other longer than 3-year life, others will be included in there. Those are subtracted from those are liabilities, consumer liabilities. So assets are $124 trillion above liabilities. I don't think this metric gets enough notice. We have a lot of strategists worry about that level. Now they're primarily about that corporate level. And for companies who've been buying back shares with that, taking on more debt to buy back shares and pay dividends, we think those companies are going to have problems because they probably haven't been spending enough on innovations and reinventing themselves as they should, more catering to what many people call shareholder value. We're learning from GE and IBM, other companies, that companies can cater to shareholders to a degree that ultimately hurt and undermines potential. And we think that a lot of companies, especially after all rated top 9, favor with a very skittish and stockholders, they were trying to buy back more shares and pay dividend, attract more interest. It's been really interesting to watch these statistics in the equity market as well. Buybacks have been taking equities out of the market float. And the other thing that happened, which is really surprising after how long we have record-breaking 10-year bull market after 0809.
And I don't think it was
entirely bull market. I think there was a very unusual one, lots of cautions. But
we
are now seeing, since the beginning of 2018, a liquidation net outflow in equities to the over 350 million. This is purchases we're adjusting for that. Things are really flows out. Whereas in the bond market, I think we've seen inflows of 675 billions. That's upside down for market view. Bonds are in the bubble, and that equities, and I'll get into that in a moment, are where more of the action is going to be longer term. What I mean by that is more of the positive action is going to be. We think that there is very little limited action left in to the positive side, and if anything, we're about a bull market in coming years. Now onto market indicators. So these are there are green flags right there for, I'll say, for the equity market. You've got the yield curve positively sloped. Now this means that long rates are higher than short rate. So in the treasury market, 10 years treasury bond yield are in the mid-60s for this 0.5%, somewhere around there. And short rate are in the 0.12% rate. That's about a 50 basis point positively yield curve. And many strategists and others think we need positive yield curve to fuel the market. It's good for financial stocks, and so they're having a bit of run here. But they just think it means all systems are go from monetary policy point of view. All systems are go. But when we move forward through these cycles, we believe the yield curve is going to flatten even further again, because innovation and the deflationary forces associated with innovation on the long end of the curve, and then on the short hand of the curve is innovation associated with very rapid unit curve. So the short is more influenced by the unit growth statistic or more by the inflation statistics. So remember, you heard that here first. Say it again. We weren't afraid last year in the curve converted, and we won't be the next time we'll does. If you look at spread between junk bond yield and treasuries, you're seeing very tight spread. A lot of willingness to take risk in the bond market. Credit analysts tend to be the most conservative equity analysts. So we often look for a move up in the spread, so that bond investors are demanding much more in order to buy junk bonds when they are treasuries. That's not where we are. We're flurry here as the market is going down. Basically, the yield spreads are high. That's a green flag. Dollar has been going down, and I would say for some, I don't think the dollar down is a great thing, because it's lots of purchasing power here in the United States. But for emerging market, which have a lot of that denominated in dollars, that's a good thing. So the economic recovery should propagate from the US and from China. China has been going through its own recovery into the rest of the world. Now that the dollar is such a burden on them. We've also seen gold. Gold has had a very nice run. It has paused recently though, because the dollar has come down. That's unusual. Usually dollar going down is positive for gold. That relationship has broken recently, and so stay tuned. We don't know what that's all about. Other commodities like copper and lumber, extremely strong and still strong. I checked on copper today at levels since 2018. So what do you make about the equity market correction here? Well, a couple of things. The 10% decline for the Nasdaq is a correction. It's not a bear market. And we actually think we needed to see something like this in order to give a lot of investors, especially those in Robinhood and elsewhere, a reality check. Hey, this market doesn't move straight up. And I probably made the mistake of using the word weak holders today. I think if investor is very short term in terms of time horizon and start to buy momentum, that's what we call weak holders. Momentum turns, they're gone. And we who are longer term holders do like to see the market tested that way, to see how low is low and how much of the recent buying activity is momentum driven. So that's interesting. Then we also know there could be a few reasons for the market to be destabilized here. One, we are seeing a flare in COVID and school starts. Temple has turned back home. So is one of the SUNY campuses in New York. We saw that University of South Carolina, 27% the students who tested were positive for that COVID, and I think another university as well. The university thing, same thing. So it could be kids, children, and lower levels going to be sent from school, burden on families where both parents were. That could be another stabilizer could be fears that will end up where we are in 2000. After the election, we won't know who is president until December, sometime in December. That's what happened. And the market will extremely settle during that time. Now there is one big difference. Back then, we're in the middle of techno-telco bust. And so this was just another variable to push that market down. I don't think that's where we're going to be. I think we're going to be a very strong economy as I try to build up here around the time of the election. So I don't think, even if we do end up in a situation like that, it'll be as damaging to the market. Nonetheless, make sure people pulling some chips off the table. And the final thing I'd like to talk about today is valuation. This metric, the PE ratio, S&P 500 right now, is about 26 times on this year's earnings and about 2021 on next year's earnings. We should be looking at the next year. The market is discounting that mechanism, but to the extent of correction makes people a little more focused on the short term. 26 times this year, typically that is being the top of the market when we hit that NIP 20 P ratio. We believe that if we are right, that interest rate structure of the market is permanently, I shouldn't say permanently anything, but for the next 5 to 10 years, below 5% at the long end of the curve, say the 10-year. Right now we're 0.65 further away. But the market has always acted as though 4 to 5% nominal GDP growth is the normalized rate of. In order to do a back-envelope calculation, was a reasonable multiple PE to pay. You divide 1 over 5, 1 over 4. That's 25 times. And so that's where we're stopped. Normalized or 5 range. If the normalized growth rate, however, 2 to 3% deflationary, thanks to the innovations that are sweeping through the world, that are all deflationary nature when we talk about 5 platforms, DNA, sequencing, robotics, energy storage, artificial intelligence, blockchain technology, that are sweeping to the world, there's going to be deflationary undercurrent. Even as unit growth is very rapid, that is highly positive for PE ratio. So if you do the inverse to the 3, what you come up with is, of course, 33 to 50 times. So we do believe that the multiple structure of the market is rising, and that for those companies, rapid growth and very high margin, which many technologies have, the multiples will be surprisingly high, and they are. We've even have adjusted some of the software service to the companies. So, like this correction like this, test them, and we're going to talking a lot more about this in the future. I wanted to come out and talk about it on a day or week like this week, when it looks like this guy is falling to some investors, especially those who are fairly new to market. So as you know, we keep a 5-year time horizon. The coronavirus pandemic has accelerated the growth rate adoption cycle of all innovation platforms, say for 3D printing has been heard by autos. We think that it can change as well. Acceleration of saving has surprised companies themselves, many of them in the last earnings season. Hey, we didn't expect to see this kind of customer coming to us for 3 to 5 years. That's quite something. We will, I believe, when history books are written, they will look back. The coronavirus has catapulted us into the new world so much faster than we ever going to be, even ARC. And you know, we are all about 5 to 10 years out. We are surprised. So stay tuned. We think this market shakeup is a good thing out of bad thing. We need to remind, especially younger investors, that the market just doesn't go straight up without a correction. We need this reminder, so I'll leave you with that. I wish you a very wonderful Labor Day weekend. Thanks so much.